Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. If you've looked at your portfolio recently, you probably did not like what you saw. Over the last few weeks, the Indian stock market has been on a roller coaster ride and mostly it's going down. Red screens, falling prices, scary news headlines. It's enough to make any investor feel a bit lost. If you're feeling confused right now, I want you to know you're not alone. Most investors in India are asking the same questions. Should I sell everything before it falls further? Is this the right time to buy the dip? What if the market crashes another 20%? In times like these, the loudest voices are usually the ones giving the worst advice. But today, we are not going to listen to the noise. Instead, we are going back in time to listen to a man who literally wrote the book on investing. We are going back to 1963. We are going to look at a framework provided by Benjamin Graham. For those who don't know, Ben Graham was the mentor to Warren Buffett. In fact, Buffett believes the speech Graham gave in 1963 is one of the best he ever delivered. Today, we are going to take Graham's 60-year-old wisdom and apply it directly to the Indian stock market of today. By the end of this video, you won't be confused anymore. You will have a clear mathematical and logical plan. So, let's get started. In his famous 1963 speech, Graham started with a very honest admission. He said he had no idea what the stock market would do next. Think about that. The father of value investing admitted he could not predict the future. However, he argued something very important. He said that a disturbing decline is likely to take place at some point in the future. He did not know when, but he knew that it would happen. His message was simple. Since you can't predict it, you must be prepared for it in both thought and action. Graham also touched on a hard truth. He said that not everyone can beat the market. Most people will just get the index return. But a small minority of investors can get significantly better results. To be in that winning minority, you must fulfill two conditions. You must follow sound principles of stock selection, and your methods must be different from those of the major buyers, the big institutions and the screaming crowds. To help us do this, Graham divided his strategy into two parts. Part 1, the broad investment policy. How much money goes where? Part 2, stock selection. Which specific companies do we buy? Now let's dive into part 1. Graham believed that the world is inherently insecure. Because we don't know what tomorrow holds, he insisted that an investor must always split their funds between stocks and bonds. In today's Indian context, bonds can mean fixed deposits, liquid funds, or debt mutual funds. Here is his golden rule for the portfolio mix. Minimum stocks 25%, maximum in stocks 75%, minimum bonds 25%, maximum in bonds 75%. Basically, your stock exposure should never drop below 25% and never go above 75%. Graham said you should change these percentages based on value considerations. When the market is low in relation to value, you own more stocks, up to 75%. When the market is high and expensive, you reduce your stocks, down to as much as 25%. Now this sounds like common sense, right? Buy low, sell high. But Graham shared a funny story from 1962 that shows how humans actually think. After a big market crash in May 1962, a financial professional asked Graham, "Don't you think that common stocks now are more risky than before because of the decline in the market?" Well, Graham was shocked. This person thought stocks were riskier because they were cheaper. That is exactly how most Indian investors feel today. When the Nifty is at 25,000, everyone feels safe and wants to buy. When it drops to 22,000, people get scared and think it's unsafe. Graham argues the exact opposite. A lower price makes a stock safer, not riskier. Graham knew that emotions are our biggest enemy. He suggested using a formula plan, an inflexible rule to keep you out of mischief. One such rule is never increase your percentage of stocks just because the market is going up. If your stocks grow from 50% to 60% of your portfolio because the price went up, that's fine. But don't move more cash into stocks just because you have FOMO, or the fear of missing out. He also warned, never go 0% in stocks. Now, some people try to time the market and sell everything. Graham said if the market keeps going up after you sell, your disappointment will be so great that it might ruin your ability to be an intelligent investor for the rest of your life. So stay in the game, but stay disciplined. Now, once you've decided how much money to put into the market, how do you choose the actual stocks? Well, Graham highlighted 3 categories for the enterprising investor. Important companies on a no glamour basis. Look for big stable companies that are not hot right now. If everyone on YouTube is talking about a sector, stay away. Look for the boring giants that the market has forgotten. Number 2, bargain issues. These are the cigar butts. Specifically, Graham looked for shares selling for less than their working capital value or book value. This means you're basically getting the factories and the brand for free. Special situations. This includes mergers, takeovers, or liquidations. Now, this is for more professional investors who view investing like a business. For most of us in India, the first 2 categories, the no glamour and bargain issues, are where the gold is hidden. You might be thinking this sounds good in theory, but does it work in the modern Indian market? Well, we decided to find out. We ran a back test using Graham's principles to see how they performed against the benchmark. Here is exactly what we did. We started with a 75-25 portfolio. 75% was invested in a basket of stocks. 25% was kept in a fixed deposit earning 6% per year. We rebalanced just once a year. If the stocks grew to 80% of the total value, we sold some to bring it back to 75. If stocks fell to 70%, we took money from the FD to buy more stocks and bring it back to 75%. Well, we didn't just buy any stocks. We picked a group of 20 stocks based on 4 strict Graham-style rules. Minimum annual revenue of rupees 200 crores or rupees 2 billion. This ensures the company isn't a tiny operator stock. Average daily trading volume of at least rupees 10 lakhs. Well, we need to be able to sell when we want. Debt to equity ratio between 0 and 1. We only want companies that are not drowning in debt. And last but not the least, the margin of safety. Price to book value between 0.3 times and 0.8 times. Why price to book value? Well, in this strategy, we assume that the company's intrinsic value is at least its book value. By buying at 0.8 times, which is a 20% discount or lower, we are ensuring a margin of safety. We are buying a rupee for 80 paise. We held this 20 stock portfolio for 1 year and rebalanced annually. How did it do? Well, the Graham portfolio outperformed the Sensex by more than double. Think about that. By simply buying boring, low debt, cheap companies and rebalancing once a year, you could have crushed the market index. In fact, we even tested a more conservative 50-50 split, 50% stocks, 50% FD. Even then, the returns were 3x, which is still significantly better than the Sensex's 1.8 times. This is not magic, it's math and psychology. This policy works for 3 very specific reasons. It automates buy low, sell high. Now, most people say they want to buy low, but the emotions stop them. When the market crashes, they are too scared to buy. By having a fixed 75-25 rule, you're forced to buy more stocks when the market falls because your stock percentage will naturally drop below 75%. You are buying when things are on sale without having to feel brave. It filters for quality. By insisting on a debt to equity ratio of less than 1, you automatically avoid the value traps. Many cheap stocks are cheap because they are about to go bankrupt, but companies with low debt and solid revenue are much more likely to survive a downturn and thrive later. It focuses on margin of safety. In the stock market, you don't need to be a genius. You just need to avoid being a fool. By buying stocks at a discount to the book value, you're protecting yourself. Even if you're slightly wrong about the company's future, the low entry price provides a cushion. The Indian market might feel scary right now, but for a Graham style investor, this is actually an opportunity. If you're convinced, here is your 4-step checklist to start this strategy. Step number 1, check your asset allocation. Are you 100% in stocks? If so, you might be taking too much risk. Consider a 75-25 or a 50-50 split between stocks and liquid cash or FDs. Step number 2, look at your glamour exposure. Do you only own the hot stocks that everyone is talking about? Check their price to book ratios or price to earnings ratios. If they are trading at 10x or 20x book value or 50x to 60x PE ratio, they are the opposite of what Graham recommended. Step number 3, hunt for value. Look for fundamentally strong companies with low debt that are trading below their book value or PE multiples below their long-term average. I think there are plenty of such gems in the Indian mid-cap and small-cap space right now. Step number 4, rebalance once a year. Don't check your portfolio every 5 minutes. Pick a date and do your rebalancing once a year. This keeps the mischief away. Investing is not about having a crystal ball. It's about having a plan that works even when you don't have a crystal ball. Ben Graham's 1963 speech reminds us that the market will always have disturbing declines. That is a feature of the system, not a bug. Your job is not to avoid the decline but to be prepared for it. If you follow a sound principle like our 75-25 split and the low price to book value selection or price to earnings selection, you are not just gambling. You're running a business. You're buying value at a discount. And as the backtest showed, that is the surest way to beat the market over the long term. Stop looking at the red numbers with fear. Start looking at them with a calculator. If you found this framework helpful, please hit the like button and share this with a friend who might be worried about their portfolio. The more we share sound principles, the less the noise can hurt us. Until next time, keep it simple, keep it logical, and stay invested.